guys, welcome to Talking Money with Nozi, personal finance made simple. Today I'll be talking about passive investing. So let's get right into it. What is passive investing? In order for you to understand passive investing, I need you to understand indexes. What is an index? Let me explain in the next slide. The simplest way to explain an index is if you and none of your friends wanted to keep track of your average weight. All 10 of you would weigh yourselves every month and record your average weight on a graph. This is a weight index made up of 10 different people. When the average weight increases, the index goes up, and when the average weight decreases, the index goes down. If you understand this very, very basic and simple example, then it means you can understand what stock market indexes are. Now that you have a basic understanding of an index, let's talk about stock market indexes. In stock markets, an index is a way of measuring the performance of a list or a group of different companies. The index goes up or down based on the movement of the average share price of the list or group of companies. Simple, right? You understand this? I'm sure you hear about indexes in the news all the time, but because you do not know what they are, you probably ignore them. Well, from now on, that'll change. You will understand what those indexes are. Here are some examples of stock market indexes that are spoken about in the news every single day. In South Africa, the most popular index is the JSE All Share Index. This sounds familiar, no doubt. You've heard this many times on the business news, right? This index measures the performance of the largest 164 companies that are on the JSE. Another very popular index is the JSE Top 40 Index. This one measures the performance of the 40 largest companies on the JSE. Then there is the S&P 500 Index. This is an index that measures the performance of the 500 largest companies on the New York Stock Exchange in the United States of America. Then there's the Hang Seng Index. You've heard about the Hang Seng before. I know it. This one measures the performance of the 50 largest companies on the Chinese stock market. Then there's the Nikkei. You've heard this one too, right? The Nikkei Index measures the performance of the largest 225 companies on the Japanese Stock Exchange or the Tokyo Stock Exchange. The Financial Times Stock Exchange 100 Index. Wow, this is a mouthful, right? It's shortened. It's called the FTSE 100. This measures the performance of the largest 100 companies on the London Stock Exchange in the United Kingdom. The indexes that I've just mentioned are examples of broad market indexes because they measure the performance of a list of many different companies from different sectors or industries on their particular stock markets. But there are other indexes that are more sector specific and therefore focus on smaller subsets of the stock market. For example, some indexes measure the performance of a group of companies in the technology sector only. Other indexes measure the performance of a group of companies in the property sector only. Others still would measure the bond index only, and others the financial index. So there is an index to suit each and every investor because all of us have got different interests and different needs and different risk appetites. So this is why I love indexes, because you are covered. If you love property, there's an index for that. You love technology companies, there's an index for that. If you want to invest in entire stock markets or entire subsets, then you go for broad market indexes. Why are indexes important to you as an investor? In my previous video, I spoke about how to choose individual stocks to invest in. You can watch that video over here, or is it over here? Anyway, when choosing stocks, you must do a lot of reading and research to look at the balance sheets, income statements, financial ratios, quarterly and annual reports, as well as other information related to the company or companies that you are interested in. This takes a lot of time and skill. Some investors are okay with this method of investing. But what about those who don't have the time, the interest, or the confidence to pick stocks for themselves, but still want to invest in the stock market? Is there a way for them to invest long term without picking individual stocks for themselves? And the answer is, you guessed it, yes, by investing in indexes. So when you invest in a stock market index, you do not have to guess which company is going to be a winner. You don't have to read financial reports or cash flow statements or balance sheets or try to keep up with political events and global trends that could affect your chosen stocks. When you invest in an index, you are investing in a group of many different companies, and you still make money without having to choose stocks for yourself. That is what investing in indexes is all about. And that's what makes it attractive. You don't need to know about the stock market. You don't need to know which stocks perform better than other stocks. You just buy the whole bunch in an index. So how do you invest in an index? In South Africa, the closest thing to an index fund is an exchange traded fund, also known as an ETF. But what is an ETF? Let me explain. Exchange traded funds, or ETFs for short, are funds that are made up of tens or hundreds or thousands of different companies that are part of an index. They are bought and sold on the stock market just like normal shares. When you buy your ETF, your money is automatically invested in the different companies that make up that particular index. On our stock market, the JSE, we have about 78 ETFs. Some of them are South African and some of them are international. I'll just talk about 4 examples. Number 1 example is the top 40 ETF, which is an index of the 40 largest South African companies on the Johannesburg Stock Exchange. Then we have the S&P 500 ETF, which is an index of the 500 largest American companies on the New York Stock Exchange. Then you've got the FTSE 100 ETF, which is an index of the 100 largest companies in the United Kingdom that are listed on the London Stock Exchange. Then we have the MSCI World ETF, which tracks more than 1,500 companies from the stock markets of 23 developed nations in the world, like the USA, Canada, the United Kingdom, France, Germany, Switzerland, Australia, New Zealand, Singapore, Japan, and others. Back to passive investing, the title of this video, right? Passive investing is where you buy and hold your investments for a long time without frequently selling and buying different stocks. Indexes, or ETFs in the case of South Africa, are the perfect way to invest passively. For example, one of the ETFs that I buy every month is a global ETF which tracks the performance of the best 1,200 companies from both developed and developing countries. That's it. There's no fuss, no picking of individual stocks, no frequent changing and chopping my investments. I just buy the same ETFs every single month, and I'll only sell them when I reach my goal for which I'm investing, which is financial freedom. You can watch my video about financial freedom over here or over here. Advantages of investing in indexes or ETFs. Number 1 is you get to invest in the stock market without needing to pick stocks for yourself. Your money grows when you invest in ETFs, and they also earn dividends. So there's no need for you to know which stocks to invest in. There's no need for you to do research, go through balance sheets, go through cash flow statements, look at financial ratios, look at global trends, look at political events. With an ETF, you invest in stocks without guessing or choosing a particular stock. You just buy a whole bunch. Another advantage is that it is low cost. A top 40 ETF, for example, currently costs about 60 Rand. The prices change all the time, guys. Remember, the market goes up and down. So at the moment, it's about 60 Rand per ETF, which means that with just 60 Rand, your money is automatically invested in South Africa's 40 biggest companies in one transaction. The same goes with the S&P 500 ETF, which tracks America's 500 largest companies. When you buy that ETF, which is about 60 Rand as well, your money is automatically invested in those 500 companies. This is cost saving because imagine trying to buy each of the companies one by one. Number one, it'll be time consuming and you'd pay a lot in fees because each time you buy a stock, there's a transaction fee. So imagine paying a transaction fee 40 times or 500 times. It's impossible, right? So the ETFs make it easy for you to invest in many companies with a little bit of money. 60 Rand, that's less than your lunch money. Another advantage is automatic diversification. When you buy an ETF, your money is automatically invested in the many different companies that make up that fund. This automatically reduces your risk of losing all your money compared to if you were to just invest your money in one company, because if that company goes down, your money goes down with that particular company. But because an ETF follows an index, and an index is made up of a group of many different companies, 10 or hundreds or thousands of them, there's very little chance that all those companies would go out of business all at the same time. Some might, but others would stay in business and your money won't be affected as much. So I love the automatic diversification that comes with ETFs. The fourth advantage is low management fees. Index funds hold investments until the index itself changes, and this doesn't happen very often. So they have lower transaction costs because there's no frequent buying and selling and changing of stocks in that index. Another thing is, by trading in and out of stocks less frequently than actively managed funds like your unit trusts or trading stocks for yourself, index funds generate less taxable income that must be passed on to investors. So these lower costs make a huge positive difference on your investment returns over the long term, guys. So the lower the fees, the better the outcome. Another advantage and an added bonus is that you can buy your ETFs within your tax-free savings account, your TFSA. This is a massive bonus because all your South African ETF dividends will be tax-free. There will be no tax on that. Because in normal accounts, so accounts outside of your TFSA, any dividends that you earn are taxed at 20%. Another bonus, which is like, it just blows my mind. Whenever you decide to sell your investments that are in your tax-free account, you will never pay any tax at all. Whether it's income tax or capital gains, you won't pay tax. In other investments, you will pay tax, whether now or later, but tax will be paid. Guys, ETFs combined with a tax-free account make for a very, very good investment case. If you are not convinced, I don't know what else will convince you. ETFs are a stress-free and a cost-effective way to earn solid returns over long periods of time. If you don't have a tax-free savings account, get one. If you're not investing ETFs within your tax-free savings account, what are you waiting for? Start. Whether you are new to investing or have been investing for many, many years, I hope that you will consider passive investing as part or all of your investing strategy. Personally, 93% of my investments are in ETFs and only 7% individual stocks. I get to sleep better at night. I am not worried about the market crashing or companies going out of business or anything else that I would have to worry about if I were to buy individual stocks 100%. It's a clever and a stress-free way of investing for both those who are experienced and those who don't know much about the stock market. If you want to start investing in ETFs or individual stocks, but don't know where to begin, you can contact me to buy my ebook for beginners that guides you on how to start investing and how to choose stocks or ETFs. My details are in the description below. That's it, guys. I hope you enjoyed this video and found it informative. If you have any questions, please write them in the comment section below and I will get back to you. Also, please don't forget to subscribe to this channel so that you can get a notification whenever I post a new video. Until then, see you guys.